On the heels of a very strong start to the year, market returns were once again robust in the second quarter, driven by what we believe is a combination of three factors. The first, increased vaccine penetration led us to inch closer towards the ultimate goal of quote unquote normal. Second, we had a highly accommodative Federal Reserve. Third, we had unprecedented levels of fiscal stimulus and what appears to be an infrastructure compromise at the tail end of the quarter. The flip side of all these positive attributes remains high degrees of uncertainty as to whether the inflation we are currently experiencing will truly be transitory. Movements in the 10-year yield over the course of the quarter suggest that the market is very comfortable that the Fed has everything under control. Performance in the second quarter was aided by sector attribution, coupled with strong fundamental execution from a few of our portfolio holdings. These names continue to benefit from the broader economic reopening, as well as solid performance gains. I'd like to highlight two names in particular. Blackstone, an alternative asset manager within financial services, continues to do a great job of attracting assets and generating performance. Coupled with its inclusion in the Russell indices at the end of the quarter, the name generated strong gains for dividend strategy. I'd also like to highlight UPS. Under the direction of new CEO Carol Tomé, which took place in 2020, the company has executed phenomenally well on pricing gains while still maintaining its commitment to delivering volume, and has generated a laser-like improvement on margins with the best margin performance in the first quarter that we've seen in some time. With respect to information technology, we continue to find it challenging to find yield from companies that align with the goals of the overall dividend strategy product. With respect to utilities, we are surprised that the stocks continue to lag. They lagged in 2020, and we thought the defensive nature of their cash flows would provide more downside protection than they have to date. We also think there's an ongoing theme here of renewables investment, and this renewables investment should drive accelerated earnings growth for the overall utility sectors. And if we combine that with the low level of interest rates and the attractiveness of the multiple relative to that of the market for the sector, we think there's reasonable opportunity for the sector to outperform from here. We took advantage of some of this weakness in the second quarter to add to one of our existing holdings, Sempra Energy. We have a lot of confidence in this well-managed California and Texas-based utility. With respect to the markets, we are currently cautious, but that caution is not warranted by complete confidence in the underlying degree of economic activity going on and the acceleration that we've seen coming out of 2020, associated with high levels of vaccine penetration, leading to a quote unquote more normal world. That being said, the market right now is very complacent on the level of inflation and inflation expectations going forward. It remains to be seen whether or not this inflation is truly transitory, and only time will tell. We have a high degree of confidence in our underlying portfolio companies and their ability to use price as a weapon, given the global nature of their brands and the defensive nature of their strategies, to offset any inflationary pressures, although there could be some lags between when they actually institute price and when that flows through with respect to margins. On the dividend front, we feel very comfortable that portfolio holdings will generate dividend growth comparable to that of years past. And heading into the pandemic, or at the onset of the pandemic, we thought that the global financial crisis would be the best proxy for where dividend growth would go to. And that would be a deceleration from the high single digits to the low single digits. What we actually saw over the course of the pandemic was that our portfolio holdings generated 7% dividend growth, which we were very pleased with. Heading into 2021, we expect to see an acceleration from that 7% growth back to the high single digits, particularly as financial services and banks executed very well on the stress test in the pandemic, should do very well on the stress test this year, and thus be allowed to return capital more flexibly.